All right. Well, I think we'll get started. I'd like to thank everybody for joining us this evening. And this is part two of the basics of underwriting for limited partner investors. And yeah, thanks for those that were able to join us for the part one. We will do a quick overview of that one. If you did not receive that recording, please reach out to us and we will definitely provide that to you so you can see it. Anyways, yeah, this one will be recorded also, and we will definitely get that out to you within the next day or two. If you have questions throughout the presentation, please feel free to enter them into the chat, and we would be more than happy to answer those at the end. I'd like to just first start with doing some introductions. And for those of you that have been able to join us throughout our previous ones, you probably heard a lot of the background of us, but my name is Mike Strodman. I'm with Blue Skies Equity. We're based out of northern Minnesota, Bemidji, and I have a master's degree in urban and regional studies. I was previously a city planner and worked on all aspects of zoning and community development. I've been investing in real estate now for about 15 years. And excuse me, we've bought and subdivided land. We've done ground up construction. We've bought properties that needed major renovations from top to bottom, inside out. But we've also bought some properties that were fairly stabilized, just needed to go in, get it cleaned up, and bring it to market rents. We presently have properties right here in Minnesota that we own and operate. We're also limited partners across a number of different states in the South. So that'll turn over to you, Brandon.
Yeah, thanks, Mike. So again, for those that haven't been on the past webinars or haven't got to meet me, I'm Brandon Gattay with By Design Capital, and I'm in Rapid City, South Dakota. So we're here in the southwest corner of the state of South Dakota, right by the Black Hills. Our claim to fame is Mount Rushmore, Crazy Horse, and some of that. Like Mike, I didn't start out in real estate. That's not my background. I started out in engineering and construction. I have 2 degrees, one in geotech or soils engineering and one in construction management. And that's really what I spent the last 10 years of my professional career doing, much more on the project management, construction management, and then business leadership side. So last 10 years, progressive roles within a couple different companies, but most recently as a senior leader in a large international construction firm. And I was able to lead a team of different sales professionals, project managers, operators, all those types of things, and really get to see all aspects of business. And I was personally responsible for our P&Ls, operating budgets of 40 million plus. And that's really where I started to look more towards the commercial real estate side of things. Like we've talked in some of our past webinars, commercial real estate is really looked at, valued, and operated like a business. So a lot of the things that I was doing in those roles, really, I started to see those synergies. So I started to transition that way. I've been investing for over 5 years, almost 6 now. Started like most in the single family space, did some short-term rentals, private lending, which I still do some private lending today. And then in the last couple years, really moved to the commercial side, the multifamily syndication space. Present portfolio right around 300 multifamily units. Need to change this slide. Just got rid of my last single family rental, so I don't have any more of those anymore. But mostly, like I've said in the past, most of my investments now are on the LP side, while I do sit on the active and the owner side. A lot of the perspective I bring is from the limited partner perspective as well. So I'm glad to bring that side of the coin to these webinars.
Yeah, and just as a disclaimer, like always, the information that we present is for informational purposes. So definitely consult a CPA, attorney, or whoever you seek guidance from before doing any investing. But here's just kind of a quick recap of the part one. And, here we looked at the terms and the process, and we look at the return metrics. A lot of times what you're going to see in these offerings is the term cash on cash. And there, what they're doing is, or what's happening is, you're looking at the ratio of cash earned to the cash that was invested. Another metric is the average annual return. And again, this is the average amount of money an investment earns each year over a given period. So now when we look at the internal rate of return, here we're looking at, looking at your profitability, what that return is, but we're also taking time into consideration with this. And then the equity multiple, which is, the total cash distributions that were received divided by the equity invested. And this doesn't have a time equivalent to it. So for example, if you invest $100,000 and you return, and you receive $200,000 back, that's a 2x multiple for that. But again, was that over 3 years or was that over 15 years? That changes. We'll dive into those in a little bit more. Another great way, there's a lot of formulas for them too. It's always neat. You can Google it and look at the formulas and kind of plug those into different things and see what returns are too on your own. But you'll definitely see those.
And I encourage you to look up the IRR. I'll tell you, the IRR equation is pretty complicated. It's definitely one that we use the formulas in our models and in Excel, but it's probably one of the most common metrics that you'll see out there. Again, we talked about that in part 1, but it's because it takes the time and all the other cash flows into consideration. It's really the best metric to be able to compare investments across different asset classes, not just within real estate. That's why IRR gets brought up so often.
Yeah. And then just in regards to our process, we do the first initial quick review. And again, taking that OM, throwing it into the Excel sheet and doing that quick analysis just to see if it's a go or a no-go. From there, if we get the go, we can do the market review. And this is where we can dive in a little bit deeper into the market. First we want to see that 30,000-foot view of the market, and then dive in right down to that block and see, what is the crime rate? Make sure that the building that we're looking at purchasing is right for that neighborhood and the similar properties around there, just so we're comparing apples to apples, and it's a business plan that we want to carry out. If we can get through that, we'll look at the financial analysis next, where we do the deep dive. We want to make sure that the information that was presented to us from both the seller and the broker are accurate, that their return or that their projections are true, and there too, that we can carry out the business plan and make sure, for example, and we'll talk about it and see this later, is, if they're stating that we can get a $200 rent bump by renovating the units, is that accurate? Is it achievable? Then that'll bring us into our offering price. And the offering price is determined by the business plan and the target returns. It is not the other way around. So, if we can't hit so whatever the returns are, we plan out a business plan, and then we have our target returns. Can we get there with what that whisper price is, or what is our offer price going to be, and what is the difference between those two? And does it still make sense, to make that offer? Here we're looking at the assumptions, the impact on the returns, and we're looking at the IRR impact and the cash on cash impact. And as you can see, the most influential factor here is the gross potential rents. And with that, again, cash on cash, there, when we look at the amount of time or the amount of time that's invested, your cash on cash will increase if the time frame is longer. Where in the IRR, that can actually be different because when you're looking at the time frame, again, in regards to how long you hold that property from purchase to sale, when we're looking at that, the IRR will be a lot better on a 3-year hold than it is on a 7-year hold. Another big factor here is the cap rate on the IRR. If you miss the cap rate, that can directly impact that return. And again, we'll be able to see that later on when we look at some real numbers. But if you buy it at a 6 and you project an exit at a 5.5, or if you buy at a 6 and project a sale at 6.5, that number will again change greatly. Brandon, what else did I miss on that slide?
No, did a great job, Mike. It's really we focus on these two because they are the most they're two most common metrics that really get looked at most of the time when we're looking at these syndications. And again, I think the big thing is between, like you said, cash on cash is much more cash flow based. IRR takes into account that time. You can see that exit cap rate doesn't actually have any impact on your cash on cash return. That's because cash on cash doesn't consider any profit from sale. It's purely those cash flows. But in either case, that gross potential rent, specifically in year one, so what you really think that income is really drives these returns. And like Mike said, well, that's really what we're going to focus on is between those two metrics in what we dive into and the rest of it. The rest of these inputs certainly are important. The big piece is they really are all baked into the business plan and they just have lesser impacts. So we're going to focus on those two.
Yeah, that is a great visual of how those impacts impact it and how some are so small, but a couple of them are huge. So yeah, I'll turn it over to Brandon. He's going to give us the real world underwriting example. I absolutely love this. It's cool. It really paints a picture and explains it all very well.
Yeah, perfect. All right, thanks, Mike. So yeah, this will be an actual example of a property that we did look at. We looked at this quite a while back, and it's fairly indicative of the types of properties we might see, or really what you'll see out there as an LP, maybe from different value add style projects. So this was one that we worked all the way through the process and ultimately didn't offer on, but we thought we actually might be close enough to move forward based off of our quick underwriting. We'll walk through each of those things. This will be a higher level, just like our prior webinars review. So there'll be pieces that we don't hit, but we're really, like I said, we're going to focus on the gross potential rent and the IRR portion and what we saw throughout this, how it was impacted, and why we walked away. But a quick high-level summary of the property that we're looking at here. A whole lot going on. The big things to point out is total number of units. So this was a 130-unit apartment complex. It was built in 1970. So these are pretty common on what you'd see for value add projects. A little bit older vintage, not obsolete by any means, but definitely in need of some upkeep. The picture here, this is kind of what you'd see. You know, it's still a nice property. It just needs some TLC and some upkeep, some renovations to some of the units to be able to get them up to that market rent. You'll also see that there's this year renovated and it says 2023. So this particular property, a handful of the units had already been renovated. I believe it was around 40 or so. And that was done in 2023. And then the next potential buyer would be able to come in and renovate the rest of those. And that's what we'll talk about. That'll be our business plan there. All right. So the project, like we said, this came to us with a whisper price or an asking price of $14.75 million based on the broker's OM and our market research. This was around a 7 cap for the market cap rate. We were able to get a quote for agency debt, which is just Fannie Mae, Freddie Mac, good, strong debt, 70% LTV, 6.25% fixed interest. With interest only, that's that IO for 2 years. So only paying interest for the first 2 years and a 30-year amortization. Our plan was to hold it for 5 years. And the business plan, the value add strategy here was to renovate the remaining 92 units that hadn't been updated over those first 2 years to achieve an average rent increase of $250 per unit per month. And that was based on what the broker's OM or that offering was, and based on their research. And we'll talk more about that. Through doing that, you can see on the pictures on the left, those classic units on the top. These are unrenovated, older appliances, linoleum. It wouldn't be a huge lift on this one. It would be mostly cosmetic. So new flooring, new cabinets, new appliances, just really sprucing them up. Through doing all of that over that hold period, the expected sale price at our target exit cap was projected to be around $21.35 million. So you can see that's a big boost in value over those 5 years. And that's really the whole name of the game in value add, and why we like value add commercial real estate is by increasing the revenue and the operating efficiencies, we can really drive that upward value with the right business plan. But we got to be able to execute it. And that's what we'll dive into here. So we'll step into just walking through our process on how we came to it with this one. All right. So this first step again is our quick analysis. And this is where we're just looking high level. We're plugging in right from the broker's OM, the numbers that they're giving. Generally speaking, the broker's goal is to paint the property in the best light possible. They're not lying necessarily, but their job is to make it look good. So we want to start with those numbers. If we can come in with what is maybe the best case scenario, and we're still not able to hit our target investor returns at that offer price, then we know this probably is something we can just no-go right away, not spend a lot of time spinning our wheels, and move on to that next deal. So that's what we did here. You can see in this quick underwriting, our whisper price here on the left of that 14.75. There in the middle, our standard deal structure. This is really common, that 70-30 split between LPs and GP, 8% pref, really standard. And then our minimum metrics here on the KPIs of minimum of 7% cash on cash, minimum 14% IRR, equity multiple 1.65. And on the right, this is just the quick filling in of info right from the broker's OM. So 130 units. They were saying that the average market rent, and that market rent would be blended between units that are renovated and what those classic units could get, of $1,275. Economic vacancies of really standard numbers of 13%, 8.5% after we do the renovation. Expenses there a little low at 42%. We'll typically see somewhere between 45, 50, maybe a little bit higher. So, but we're running with their numbers. And then again, at the bottom, that renovation strategy, 92 units. And then based on the OM, expected to be able to get rent bumps of $250 per unit per month by doing a renovation of about $10,000. Ran through all that. As you can see along the top, we do meet our metrics. We meet our minimum returns for our LPs. So we're ready to move on to that next stage here. And this is intended to be just a quick 5-minute go, no go before we waste a bunch more time.
And again, like Brandon said, this is just gathering the information from the OM, from the broker, plugging it in here, and yeah, go or no go.
Yep. So on this one, we decided we had enough to move on to that next stage. This is where we move into the market analysis. We did a webinar. I think it was our second one that dives in deep on all the different metrics. Like Mike, you had touched on a few of them. We look at crime rate, population growth, wage growth, those types of things. The big thing is you really, at this stage, we dive into that submarket, like Mike had said. We want to know what it's looking like on the block that this property is. We all know that on one side of tracks or the other can be vastly different. For what we want to show and look at tonight, specifically, without going through all those different pieces, is really the supply and demand side. And this is something I highly recommend as an LP or a GP. This is something you're really looking at and asking questions about, because it really drives that rent growth number and that gross potential rent that we said was so important. We'll see further on in the presentation here. But what we're looking at, so we started with rent growth. What's happening in this submarket? Not just the submarket, but also specific to the asset class. You want to make sure that when you're looking at these trends and doing rent comps, you also want to look at, are they like kind properties? This is a B minus property. So we don't want to be looking at trends for A class properties, and we don't want to be looking at trends for C class properties. We want to make sure we're looking at the right asset classes. So this is rent growth over time, quarter over quarter for the last several years for this specific market. And this is a really common trend right now that you'll see in most markets across the US, where things were fairly level, growing well before COVID, and then COVID times happen. We get this big spike. Now things are coming back down, but we're not just seeing them come back to pre-COVID levels. We're seeing rents really flatline in a lot of markets, and in some areas actually have negative rent growth. So rents are declining. This particular one you can see here in the last few quarters, pretty flat, even a little bit of negative there. So it's probably pertinent for us to really look at this and forecast very little to no rent growth in year one, and be cautious about even year two. In this case, we did forecast it at zero rent growth. And when I say rent growth in this instance, this is organic market rent growth. So we're still projecting that we'll be able to move rents up with renovations to meet market, but we're saying that the market isn't going to organically grow across the board. This next slide, this really speaks to the supply and demand. And the next piece that we really look at, and I encourage you to look at as well and ask questions about, is really that true supply and demand, and what's driving the rent growth numbers there. This is a busy graph, but really what you want to look at is those green bars is units in this market that were under construction. Like a lot of markets, there's a wave of units coming online that were under construction the last few years, and now they're coming to the market. This market was very similar. The blue bars are deliveries. So you can see those are coming online as the under construction goes down. Red bars is absorption. So how much of that is actually being absorbed. And this purple bar is the vacancy. So as all these units come online, there's new units. People aren't filling them as fast as they're coming to market. So we see an increase in vacancy, which usually that's a big driver of those rents staying flat or even declining in some areas, just to get people to rent those until they fill up. So this is very common to see right now across the US in many major markets and even smaller markets. So something to be aware of. This is really where we look at and say, we're not going to expect rent growth really in the next year or two, maybe. But under construction's dropping. What's not on this graph is building permits. This is also pretty common across the US right now, but specific to this market, new building permits had really dropped off. New builds development is really tough right now with interest rates where they're at and things like that. So building permits are way down. So we're fairly confident that though it might be slow in the next year or two, that we'll get back to maybe normal levels. We're not expecting this to come back to these big 10% rent growths, but we're fairly confident that this area will come back and we'll have a good solid market that we can trust for the long term.
Yeah, I like this graph too. And like you said, it's busy, but it's neat to see how everything's correlated. And right, as this new construction starts to wane out and they start getting these units rented, it'll be interesting to see in the future. Like Brandon pointed out, new construction permits are virtually zilch, across a lot of markets. So then it'll be interesting to see the inverse of a lack of supply, not in all markets, but in some, there'll be a lack of supply, which will then drive up the rents again. So it's kind of that roller coaster effect because, from start to finish on these large properties, it's a significant amount of time. You're looking through the permit process, the construction process, and the lease up process. It can be, a couple of years. So.
Yep, absolutely. All right. So once we get through that market analysis, we still like it. This is where we really dive in and go into the financial analysis. The biggest determining factor here, again, is that GPR. We're going to focus on that. What are the market rents? So this is where you really want to make sure that your sponsors or the brokers or the comps that you're making are in alignment. You want to make sure that these rent comps are similar in age, location, amenities, asset class, to the property that you're looking at. So in this example here, this is actually directly from the broker OM. It's very similar to what you should be able to see from any offering. If it's from a sponsor to invest in a project, you should see something similar here. These are, it might be a little small here on the screen, but these were the properties that they were comparing rents to come up with their market rents. You can see here on the left, you remember our target property was built in 1970. This project this property on the left, built in 1971. From the photos, it looks fairly similar. This is probably one you could trust as a good comp. Whereas the Chadwick here next to it, you can see this was just built in 2022. Big property, nice pool, very high end. This is very much an A-class asset. You can see that the rents are much higher. The 6016 is very similar. The rest of these are probably okay comps, but this is the big piece here where it's very easy to look at an overall market, see all these properties and say, oh, well, some guys are getting 1,600. We could raise our rents a little bit more and edge that gross potential rent projection up. It's really important to make sure that those comps are of like kind assets.
This is kind of that picture where even for kids, where they'll put a bunch of different pictures and say, which one does not belong? And where you go through and select out a couple of them and pull them out because, those are definitely comps that you do not want to use. Although sometimes when you look at the OM, the offering memorandum, they will be in there. So.
Yep. And this is just a comparison. So this is as we started to really dive in and do our own analysis here, showing the differences from what the broker was showing and what our analysis showed. And again, this is really to show why deals aren't penciling. It's tough to get them to pencil. It doesn't mean that we're necessarily always correct either. Other folks can have different business plans, but this all comes back to what we talked about. We're building our business plan and we're going to make our offer price based on ours and not let others' assumptions influence ours. But this comparison here on the top, this is just for one bedroom. So this property had a mix of 1 bedroom, 2 bedroom, and some 3 bedrooms. So just looking at the 1 bedrooms based on their comps, again, that we were just looking at, their gross potential market rate is a little over $1,200 a month. When we went in and did our analysis, where we took out some of those higher end properties, really looked at properties that we thought were comparable, you can see at the very bottom there, we came to a blended rate of just under $1,120. So we're off by $90 a month on those 1 bedroom units. Again, this is blended, so you can see on these bottom graphs, these are our comps. That's the blue bars, those are renovated units. The orange bars there are classic units, and we want to split the difference between the two there, and then we project our rents accordingly. You can see we're quite a ways off, or maybe it doesn't seem that. Maybe $90 a unit doesn't seem that far off. But when we look here at the total impact, when we look at 1 bedrooms, 2 bedrooms, 3 bedrooms, and what our analysis showed, the broker year one projected gross potential rent was just over $2 million. Our year one was 1.9, a little over it, with a variance of about $145,000 annually, 7% lower than what the broker was showing. The big thing to see here is if we remember these properties are valued based off of their net operating income divided by that cap rate. So this can have a big impact. At the 7% market cap, this reduction of $145,000 is the equivalent of almost a $2.1 million reduction in value, purely based off of that, not taking into consideration any other aspects or anywhere else we could bring it up. But just off that GPR miss and difference in our rent comps versus the brokers, it's a $2 million plus reduction.
It makes a big number.
So moving on from there, that gross potential rent, again, if we remember from part one, gross potential rent is the maximum income that we could get at market rates, every unit filled, everybody paying. But we know that that's not reality. So we need to be looking at what is our economic income or economic occupancy, and what are the losses that we see. So the losses that we project are general vacancy. That's units that aren't leased, just physically empty. There's concessions. So are we giving a month free of rent for new leases to keep that vacancy up or get people in at the higher rates? Bad debt, that's folks that just aren't paying, that we have to evict and we can't collect that money. And then that loss to lease is the difference between what our current leases are versus what that market rent could be. As we take over, we're saying here's the market rent, but we have existing leases already in place that may be there for up to another year, right? And that delta between the two is that loss to lease that you need to make sure that is being accounted for. All that together, again, is your economic income or your economic occupancy, which on a stabilized property, like we talked during the last webinar, should be around 90 to 92% on average. Once you're stabilized, after you've done renovations, you've gotten occupancy up to where it needs to be, that's about where you want to target. So when we look at this portion of the comparison between the broker pro forma and what we had analyzed here, there's a couple that really stood out, and these are fairly common. I see these either missed or just maybe not taken as far into consideration as I would think they should be, and those are downtime vacancy loss and loss to lease. So like we said, this is a value add project. That's our business plan, is to renovate 92 units over 2 years. So on average, about 3 of those units a month are going to be down for renovations. We know that that'll have a loss, and then we still will have a regular general vacancy of the units that aren't being renovated. We're still going to have units that people move out of. So we need to make sure we capture both. I see very often that this downtime vacancy may be captured in the general vacancy or captured in the loss to lease somehow. And that's okay. The big thing is to make sure that it is being captured, number one, and that you believe and you trust the logic behind how much they're adding there to make sure that it's accounted for. In this case, the broker pro forma did not account for it at all. It just really assumed that year one, you're going to renovate, get everything up to market rent, and not have any losses there, which we weren't comfortable with, obviously. The other big one there is that loss to lease. In this case, I think I'd said that's the difference between what we're getting leases at now and what we think we can get rents up to. They're at about a 7% loss to lease, and market's at 1%. So they're saying stabilized, you should be at 1%. And that's fine, but we know that it'll take time to get to that 1% loss to lease. A lot of those leases are existing. You can't just come in and instantly raise rents. You got to wait for those units to turn, sign new leases at the higher rents. So this, we typically will go about half and assume, unless we have a good reason to go one way or the other, so we can get about half there, but we still need to have that loss. So that adds to our overall income loss. And now between that gross potential rent difference and these different losses that we're adding in, we're up to about $309,000 less in income that we can expect, or we're going to project, than the pro forma, which again, at that 7% cap rate, now we're up to about $4.4 million in value reduction, just off of those, not taking anything else into consideration. So it has quite an impact there.
Those numbers really do start adding up, once you start, peeling back the onion on each and every piece.
Yep. Yeah. So then from there, after we get through the income, we look at the expenses. Again, back to part one of our webinar series here on it. This is where we normalize those expenses. We look at how it's performing. We look at what the broker says it's going to perform, and we look at what our business plan is and what we think we can get it to perform at. These are just some of the common expense items that you'll see, and these are some common ranges, but they are very market and asset dependent. So certainly don't want to rely on these, but these are a good rule of thumb to see if you're in the ballpark at least on these properties. Yeah. So when we looked at this project versus the broker pro forma and our projections, there are a few items in the expenses as well that really jumped out to us. where we had some discrepancies. And these are fairly common areas that you'll see a lot. And they're generally bigger ones that'll move the needle a bit more than others. So that first one there, payroll, this really needs to be based on your staffing plan. So brokers pro forma was at 1,200 per unit per year, and we were at 1,620 per unit per year. This was based on an actual staffing plan and building out a budget for that staffing plan. It's actually the property was performing at about 1,600, and the broker's thoughts were you could probably lose one of the maintenance techs. And we just didn't agree with that. We actually confirmed with a property management company in this market that they would have agreed with our staffing plan. So there was a big discrepancy there. Again, that doesn't necessarily mean that we're right and they're wrong. This is just what we feel comfortable with from our business plan and our strategy on how we want to staff it. The next one that you see is repairs and maintenance. This is fairly often something that is maybe under exaggerated on the broker pro formas and will be a little bit higher. In this instance, however, they were capturing some other CapEx expenses and some make ready expenses in their number of that 600 per unit per month or per year. And we actually were able to come down a little bit from that. Part of that is because we break out our make ready expenses. But the other piece is because we're doing value add, our CapEx plan was to come in, renovate some units, and take care of some of these bigger maintenance items. So realistically, our reoccurring maintenance expense, at least in year one, we had estimated being lower. We know that it's going to go up year over year. So after year one, we would project that to increase. But this was an area where we actually felt like we could do better than the pro forma. So it doesn't just go the wrong direction all the time. Third here is taxes. This was another unique situation in this one. Taxes, a lot of times we'll see underrepresented on these pro formas. And it's something that you want to make sure is calculated for that very specific property based on their tax rates, not a percentage, not a swag, but actually calculated. In this instance, even at the whisper price, but certainly at our offer price, it was going to be less than the prior year's assessed valuation. Went through, spoke with the tax assessor, spoke with some tax advisors, and their recommendation was that it was very likely that we would be able to get this reassessed lower, and this would have been the tax rate. So a pretty good savings here. Realistically, if we were to have moved forward on this, we still probably would have projected this at that 186, just for a little bit of cushion, and knowing that that's not guaranteed that we're going to get that reassessment. But we wanted to see, hey, will this even meet our projections? Are we in the ballpark, even if we are able to get that? But that's something you want to be really specific about and make sure one way or another that there's logic and good reason behind the number that's chosen there and projected. And then lastly here, we talked about this a lot on part one of the webinar, is insurance. Insurance have gone up significantly over the last year or so. So don't rely on just what you've seen in the market prior. The broker had this projected at 600. The quotes that we received, and we got multiple quotes on this one, was around 850 per unit per year. And we're seeing that pretty across the board on properties increasing pretty drastically, even in markets that maybe had not seen some of those prior. They're starting to see those. I've heard that maybe that's flattening a bit and even maybe coming down. But the moral of the story there is to make sure that there's quotes that back that up, because it's a moving target right now and has a big impact.
Yeah, moving target's a good way to put that. Another thing that you said I wanted to point out again was, talking with property management and the ones that are there and other ones in the area that you may end up switching to, just to see what they see as normalized expenses, because market to market it can be different. So
absolutely.
It's a lot of work. You really need to do your due diligence, but it's very important because, as you've seen through these numbers, and it can really directly affect where this property is going to end up going and what those returns at the end of the day or at the sale are going to be.
Yep, absolutely. And as LP investors, you don't necessarily have to do all that work yourself. You certainly can. But the big thing is to make sure you know what questions to ask sponsors that you might be investing with, where they're getting these numbers, why they choose these numbers, and really where they should be looking to get it. It's really just making sure you trust that they have a good reason for choosing those assumptions. And like Mike said, it does make a big impact. In this case, we were about $64,000 more in expenses than the broker OM, which that has a direct impact of about $900,000 in value reduction purely at that 7% cap rate. So a lot of reductions here. Again, we're talking about why it's so hard to make deals, or I don't even like to use the word make deals pencil. It's so hard to hit the values that are being asked right now at the returns that we need to see. So what does that really mean? All this boiling down into what's our offer price? Again, we determine our offer price based off of our business plan and our minimum returns. We don't back into it. We don't try to develop a business plan based off of the asking price to hit our returns. That's the big thing here. So we go back, brokers OM whisper price of 14.75. We were able to hit those returns. After we went through our full underwriting, our offer price was 11.9. So we're not quite that $5 million reduction. We did have some other value add pieces in there, through our renovations as well. Some other implementing a RUBS program, some other items where we could find some efficiencies, but still obviously quite a bit less than that whisper price that we thought might work. And ultimately not even quite hitting those same returns. We still hit our minimums, but you can see cash on cash IRR. It's all a little bit less than even we thought. So right at the very bottom at that 11.9 for what we'd accept. The big thing looking at the differences here, these metrics down here on the comparison on the left, those are our numbers versus the broker and that quick underwriting. Really, you can see it all boils down to that gross potential rent. All these market rent numbers, we were off by a ways from what the broker was projecting, and that really had a big impact. And ultimately, we were too far off from that asking price at that 11.9 to really get to an LOI. And that's a point there as well. This is still all at that offer stage. This could very much change once if we were to go under contract. We go through full thorough due diligence, and we are able to go through each and every unit, really dive into those financials really deep. This could still change. So again, just more of the why behind the challenges right now to get deals that really hit those returns that we feel comfortable offering to investors right now. So what does that really boil down to and look like in terms of the sensitivities, and how does this really look? So lots going on this slide, but we'll walk through them. And really this is intended to show just how little changes in each of these can really impact not just the returns from a percent standpoint, but your actual dollar returns. So here at the top, that gross potential rent, you can see if everything else is held flat and we only change that gross potential rent number, you can see what these changes are. We were just below this 1125. This is about where we were. We were just under it. But you can see if we were overestimating it and it's really 1075, those percentages drop. Maybe not real quickly, but you can see the dollar impact if you were an LP investor in this actual deal at our offer price of 11.9 million, and we missed that gross potential. That's potentially $17,000 less in total in return to you as the LP over the life of it. The percentages change. Maybe those don't look too bad, but we're still overstating. And likewise, if we missed it and we were under, you could certainly make quite a bit more. You can see the difference there. That $1,200 that the broker was projecting is a $24,000 difference over the life of that investment. And those percentages look pretty good too. We look at the exit cap rate. Again, this is just holding everything else the same and only adjusting that exit cap, what those impacts are. So our practice is generally to take what the market cap rate is when we purchase and project that the market might soften a little bit over the life of that, which means that cap rate goes up, just to give ourselves that little bit of cushion. We don't know what the market's going to do over 5 years, but unless we have really good reason to believe it's going to get that much better, we're certainly going to err on the side of caution. We typically do 5 bips or 5 basis points. So in this example, market rate was 7%. We projected 7.25, that 5 bips over the 5 years as our exit, and where our returns were. If you project the market's going to get significantly better, you can see how much of an impact that has on IRR and your total return. But again, it doesn't actually change your cash on cash. You can see cash on cash stays the same because this is only impacting what your sale price is, not what the cash flows are. And cash on cash is just looking at cash flows. IRR takes into account that sale price, the time value of money. But you can see from a dollar standpoint, that could be a pretty significant swing. And then when we look at just the overall kind of sensitivity and overall distribution of what you might see between the two of those across this investment, you could see very worst case, you could be down around 10.7% IRR, or you could easily project a 21.1% if you're at that $1,200 a month that the broker projected, and that you project the market's going to get just 0.5% better, just from 7% to 6.5%. So you can see a pretty drastic swing there on how easy it is to overstate or understate those projections just with little tweaks in the numbers. And again, that's really just to drive home the need to make sure that we're basing it off a business plan that we believe in, and that we do our due diligence on what those assumptions are. Even the growth rates, even that market rate, we don't know those for a fact. We can't project the future for a fact. We want to make sure that we have good reasons, and we do our analysis to make a projection that we're comfortable with and confident in. And percentages, like I said, percentages can be tough. So the last piece to really drive it home is what does it look like in terms of overall change in dollars again. So on this final slide here, we'll go to that next one, Mike, is what does this do to your bottom line as the investor? So the same kind of sensitivity analysis. This just looks at this exact project. If you were an LP investor and invested $100,000, what the difference from what we projected you would get from your total return versus what you'd get if we changed these numbers just a little bit. So you can see if we were down at 1075 a unit per month for gross potential rent, and we missed the cap rate and the market softens and goes to 7.75, could be a total of 23,000 less than what we had projected, where we were hoping to be there at that 7.25 cap and about 1120 a unit per month GPR. And if you go up to that 1,200 a month GPR, even at that and at the broker's 7% cap, that's a $30,000 difference based off of what they had projected from what our projections were. That's $6,000 a year in terms of your returns that are just changed by those couple little tweaks. So just to drive home a little bit more of the importance there of just doing that due diligence, especially in the market right now. So this is why it's really tough. We talk about conservative underwriting. You hear that not just from us, but from all sorts of operators. But conservative underwriting means it can mean something different to everybody, and it's also based on what level of risk you're willing to take as an investor. And that's really where that decision comes to you. Like I said, just because another operator might have looked at this and said, "Hey, we feel confident that we can get to that 7 cap and 1,200," doesn't necessarily mean that we're right and they're wrong. It's just a different risk profile and a different business plan. You just want to understand the whys on how they're getting there.
Yeah, no, well said, Brandon. And you're right. Nobody has that crystal ball to kind of see where that market's going to go. Rents are going to go, interest rates are going to go, everything of the such. But yeah, for us, we want to be conservative. And when we underwrite, this is why a lot of them don't tend to pencil out. You're getting a broker's OM that, in our opinion, is a little bit aggressive. So you try to boil it all down, plug it in to what we feel is the correct business plan, rate projections, and go with that gut feeling. And I don't know, being conservative is good. It can cripple us in some instances, but as as Brandon has showed us and pointed out, if you're off, and if you're off by not a lot, $80, $90, what that can really do to the numbers on the back end. So as we always say, we would much rather walk away from a deal and look for another deal than to get too far in front of our skis and not be able to perform and do the business plan. So no, thanks again, Brandon. And as we always say, we appreciate you guys coming and watching these webinars. We wanted to give you that look behind, that peek behind the curtain as to how this all comes together, why we say yes to some projects, no to other projects, what our concerns might be, and all the different resources that we use to try to get these answers. So it's been fun and good. I'm looking forward to our next webinars, but again, hopefully this one has helped you guys.
Yeah. No, thank you guys all for joining us. And as always, here's our contact info. If you come up with other questions afterwards, you want to go deeper, please feel free to reach out at any time. More than happy to share or walk through anything that maybe didn't make sense. I know there's a lot of, especially in these underwriting ones, a lot of things that get a little bit more in the weeds maybe. So happy to talk further anytime.
I'm going to we got some questions in here. Thank you. And if anybody else has some questions, please feel free, put them in here. As we said before, if you think of it afterwards, I know that happens to me a lot of times where jump off a webinar and 20 minutes later, I'll think of something, reach out to us. But Matt's got a great question. And as an LP, what metric do you care about most?
I like that question. That's a good
Brandon,
question.
start it off.
Yeah, and I'd say this is going to be different for everybody, and that's why I really like this question. It really depends on what your investing goals are at that time. If you're looking for cash flow, if you are looking to get more regular distributions, you're going to care a lot more about cash on cash return. That's the metric that tells you realistically what your distributions might be through the life of it. Whereas if you're not necessarily looking for those distributions, but you like the upside on the back end, that IRR is a more important metric to you. That tells you that there's more upside on it. So I personally, as an LP, I actually like to look for a good blend. I like to see cash on cash being at least half of IRR. So I know that there's a little bit of both baked in there. And I look at that cash on cash a little bit as a kind of a cushion or a shock absorber where, if the market doesn't appreciate as much as we thought, well, at least I'm getting some cash distributions throughout the life of it that can offset it a little bit. So yeah, not a direct answer, but that's kind of what I look for.
Yeah, I would have to answer fairly similar. And it kind of depends too, looking at the time horizon. Obviously, IRR is going to take that into it, but how long do they plan on holding it? But because if there's been times where we looked at doing a 10-year hold and the IRR looks really low, but the cash on cash throughout it's really nice. And also looking at the AAR, my overall return, what are we looking at that to possibly be? So those are the couple of the ones I look at too. Eric's got a question. Did you design your analysis spreadsheet or do you use a software program?
So I did not design this. This was designed by a gentleman named Craig Drummond, who he actually has his own small company where he's developed this and will actually he sells it on the open market. The MFA tool, you can look that up if you're interested in it. Please reach out afterwards. It's a great tool, fairly inexpensive, but it is a very detailed analysis tool for really in depth underwriting. But it's a great tool that Craig designed there.
Yeah, there are a number of different softwares out there and spreadsheets that you can use. I've seen a lot of them. I've looked at a lot of them from different sponsors that bring that bring deals to us that want us to analyze. So every time we look at one, it can be different. So it takes you some time to kind of get back into it and remember all the sheets and where everything's linked to. But like Brandon said, this one that Craig has created is I don't think I've never seen a more in-depth one. Brandon is an absolute master at that sheet. And it is so in depth. It's almost scary. It's so neat because, like he said, if you're going to go in and renovate, 50 units, how long is that going to take? It's highly unlikely that you can put it in your pro forma like it's going to be done in 1 year. This can be, you can plug in if you're going to do 3 a month. It'll extrapolate that all out and show you your vacancies with and your increase in rents. It'll pull it all together and give you that snapshot, which is great. So no, like Brandon said, Craig's is phenomenal. Garrett, how long does it typically take to do a deep dive on the underwriting compared to a quick underwrite?
I would say, if I go in full level of detail and I have good information from the broker, I have a good T12, a good rent roll to use. I can work through these in 45 minutes, maybe an hour, and have a pretty thorough underwriting that I feel confident in. But that's I'll caveat that with it's using this pretty in-depth underwriting tool, and I have a lot of reps through using the tool, so I can move through it pretty quick. But yeah, 45 minutes to an hour for me to feel really comfortable with it if I have the info.
Yeah, like what Brandon said, if you have the info and it's good and it's laid out correctly, for me to do an underwrite, it's a lot longer. I just I don't love spreadsheets as much as Brandon. And so, yeah, when I do a deep dive into it, I have to set aside quite a bit of time. It's got to be quiet and just so I can concentrate. But it's fun to do. It's interesting to see how it all works out. But yeah, that time variance can be a lot. And because if you don't have what you have, now you got to reach back out to the broker. If you have questions, something's not adding up, you got to reach back out. And that can really that can really cripple your timeline. But
and I'll say that's the analysis to get to an LOI. Like total, it shouldn't be a stagnant document once you're done with it either. If you get under contract, there's a lot more time that goes in as you're really learning what the expenses truly are. You're finding out different things through your due diligence. So there's a lot more time that gets put in, and it should always be a living model. And I say it that way specifically because it's a business plan, right? Like that's, in my opinion, that's how this needs to be looked at when we're talking about true underwriting. And just in general, these are little businesses. An apartment complex is a little business you're going to run for 5 years. So businesses change over 5 years. So it needs to be an evolving process and something you're always coming back to.
questions in regards to the recording. Yes, we will get this out to you. You registered for the event. We will get that out to you within probably maybe tomorrow, but I would say definitely by the next day for sure. If you do not get it, please reach out, take a screenshot or a picture of this so you can reach out to us and let us know. But yes, you should get that in your inbox. Also, yeah, thank you all for the kind words. We appreciate your kind words for us, but we're more appreciative of you guys seeing this because it's neat. It's fun to share. It's fun to go through all this. And then last question here is, do you all prefer the MFA or the SDA?
I'll answer this on a high level and not even necessarily say just those two. My high level answer is I think for anybody that's going to go through and do a full level underwriting, a tool like the MFA, which I don't get any kickbacks for it, I think is the appropriate level of detail that is needed. It is a full blown business plan, and that to me is what's needed. SDA and some of the other tools like that are great tools. I think they're fine to use. They don't go to that same level of detail, and where you can get into trouble with those is it just drives higher level assumptions because you can't break out the numbers as much. So my short answer is I prefer the more detailed style of MFA to SDA, but I also wouldn't recommend anybody who's not truly wanting to go in and do that level of underwriting to go get that tool and try to go through it, because it is a large model and not necessary if you're not going to go to that level of detail.
Yeah, no, I would agree. I mean, they're all different. But yeah, the MFA is amazing. It really is. With that, I do not see any more questions. And yes, again, we'll get the recordings out. Some of you asked about the first recording too. We will get you that one. We will definitely get this one out. And yeah, if there's anything we can do, let us know. Give us a call. We always love chatting real estate. So thanks again. Have a good evening.
Thanks, everybody. Have a good night.